Hey everyone, welcome back to Corporate Decoder. Today we are diving into the strange financial world of C21 Investments, a cannabis company. And let me tell you, their financial reports are more tangled than a Rastafarian's dreadlocks. Prepare for some serious financial acrobatics. C21 Investments just released an updated report covering a weird transition period. Instead of a full year, it's only for 2 months from February to March of 2024. Why the sudden change? Well, they shifted their fiscal year end to March to supposedly give themselves more time to do their accounting. But what does this mean for the company and its investors? Let's decode this report and find out. First, let's talk about the money, or lack thereof. Looking at their balance sheet, C21 Investments had total assets of about $55.2 million as of March 31st, 2024. But here's the kicker, they also had total liabilities, basically what they owe, of around $24.3 million. That leaves them with roughly $31 million in shareholder equity, the value theoretically belonging to the company's owners. Not fantastic, not terrible. Now let's look at the income statement, basically how well they made money during that short 2-month period. Their revenue was roughly $4.5 million. After subtracting the cost of goods sold, the direct costs of producing cannabis, they were left with a gross profit of about $1.8 million. Not bad for 2 months, but then comes all the other expenses. After subtracting those expenses, their income from operations or profit from normal business shrinks to a mere $290,000. Then income taxes take a big bite of $372,000, leaving them with a net loss of around $74,000. So even with decent revenue, they still ended up in the red. It is worth mentioning that these numbers are quite volatile. The previous year showed net loss of $3.3 million, so the company is still in quite a turnaround position and the 2-month period might not be representative of its operations. But wait, there's more. The Statement of Comprehensive Income shows something called Other Comprehensive Loss. Essentially, this deals with changes in value not reflected in the regular income statement, such as currency fluctuations. This adds an extra loss of around $800, making their total comprehensive loss about $73,600. Now, let's shift our attention to what they own, their assets. Inventory, the cannabis they are growing and selling, stands at $2.8 million. Accounts receivables, the money owed to them by customers, is at $254,000. These two are indicators of current operations. The company have intangible assets including licenses and goodwill. Goodwill, which sits around $28.5 million, represents the premium they paid when acquiring other businesses. That's a huge number, and it could spell trouble if those acquired businesses don't perform well. If those businesses don't perform as expected, that goodwill gets written down and the company will recognize an impairment. Turning to what they owe, their current liabilities including accounts payable are over $2.5 million, and income taxes payable is a whopping $10.2 million. They have long-term lease obligations totaling over $9.1 million. These high debt levels can choke a company's growth. Shareholder equity, that's the value theoretically belonging to the owners of the company, shows common stock issued at around $105.5 million, plus a deficit accumulated losses of $72.8 million. So it is not looking too good. One thing that's interesting is that the functional currency of C21 Investments is the Canadian dollar, while their reporting currency is the US dollar. All their operations, however, take place in the US. Currency translations are always a wild card, but it makes sense for this company. C21 Investments also exited its operations in Oregon, classifying them as discontinued operations. They sold some licenses, terminated some leases, and are now trying to sell off the remaining assets piece by piece. It has been a messy departure and is not a good look for the company. Now let's talk about the accounting policies. The report highlights the need for estimates and judgments. Determining the value of goodwill, inventory, deferred tax assets, and derivative liabilities all require significant management assumptions. These assumptions can be subjective and could easily lead to big swings. The report highlights some unique risks and tax challenges. Because cannabis is still illegal at the federal level, C21 Investments can't deduct many normal business expenses because of something called Section 280E of the tax code. This dramatically increases their tax burden and is frankly unfair. Finally, the company is involved in a number of legal disputes, including an old suit regarding acquisition of some farms. These legal battles add uncertainty and cost to C21's operations and could spell more bad news if the company needs to divert resources to deal with lawsuits. So what's my take on C21 Investments? Financially, C21 Investments seems shaky, but there has been some operational progress. That said, the goodwill is a constant worry, the discontinued operations have been a drag, and the high debt is not ideal. All while operating in an extremely turbulent market. As for risks, Section 280E remains a huge burden, and this won't change until federal laws changes. If the government makes some decision about cannabis policy, that could easily impact the company. But there are opportunities here as well if the company can actually improve operations. In conclusion, C21 Investments is a high-risk bet. There is potential for growth in the cannabis industry, however. C21 needs to shore up its financial foundation, control its costs, and grow revenue. Thanks for watching. If you enjoyed this video, please subscribe, like, and comment, and let me know what company you'd like me to decode next.